not financial advice. The information provided in this video is for educational purposes only and should not be considered as professional financial advice. It's essential to consult with a financial advisor before making any decisions regarding your financial situation. Welcome to our channel where we explore the world of finance with clarity and transparency. Today, we are discussing whole life insurance, a topic that has been surrounded by controversy and misconceptions. Whole life insurance, also known as permanent life insurance, is designed to cover you for your entire lifetime as long as premiums are paid. It also accumulates a cash value over time, which can be borrowed against or used to pay premiums. However, for about 90% of people, whole life insurance might not be the best choice due to its complexity, high costs, and the existence of more straightforward and cost-effective alternatives. Let's dive into the details to understand why. Whole life insurance combines a death benefit with a savings component known as the cash value, which grows over time. The premiums are usually fixed and typically higher than those of term life insurance. The cash value can be invested in various assets and it earns interest over time. This sounds attractive, but the truth is the returns are often low and the fees associated with whole life insurance policies can be substantial. Furthermore, whole life insurance policies are complex and difficult to understand, even for financial professionals. This complexity can lead to misunderstandings and mismanagement of the policy, which can have severe consequences for the policyholder. In addition, whole life insurance is often sold with the promise of high returns on the cash value component, but these returns are not guaranteed and can fluctuate over time. This means that the policyholder may not get the returns they expect, which can be a significant disappointment. To make matters worse, whole life insurance policies often come with surrender charges, which can be hefty if the policyholder decides to cancel the policy. These charges can range from a few $1,000s to tens of thousands of dollars, depending on the policy and the insurance company. So, before buying a whole life insurance policy, it's essential to carefully consider your financial situation, goals, and needs. You should also shop around and compare different policies from various insurance companies to find the best fit for you. It's also crucial to read the fine print and understand the terms and conditions of the policy, including the surrender charges, fees, and any other costs associated with the policy. By doing your research and being aware of the potential pitfalls, you can make an informed decision about whether whole life insurance is right for you. Now, let's take a break and come back to discuss the reasons why whole life insurance might not be the best choice for most people. As we discussed earlier, whole life insurance is a complex and often expensive product that may not be the best fit for most people. So, why do insurance companies and agents push whole life insurance so aggressively? The answer lies in the commissions and fees associated with these policies. Insurance agents and brokers often receive high commissions for selling whole life insurance policies, which can be a significant source of income for them. Additionally, insurance companies charge various fees such as administrative fees, management fees, and surrender charges, which can add up to a substantial amount over the life of the policy. These fees and commissions can make whole life insurance a lucrative business for insurance companies and agents, but they can also make it an expensive and potentially unsuitable product for consumers. Another reason why whole life insurance might not be the best choice is that it often doesn't provide the best returns on investment. The cash value component of whole life insurance policies typically earns a low rate of return, often in the range of 1 to 3% per annum, which is lower than what you could potentially earn from other investments, such as index funds or real estate. Furthermore, the fees and charges associated with whole life insurance policies can eat into the returns, leaving you with even lower net returns. This means that if you're looking to grow your wealth over the long term, whole life insurance might not be the best option. Instead, you might want to consider other investment vehicles that offer higher potential returns and lower fees. For example, index funds have consistently provided higher returns over the long term with lower fees and less complexity than whole life insurance. Now, Let's move on to discuss some of the alternatives to whole life insurance and how they can be used to achieve your financial goals. One of the most popular alternatives to whole life insurance is term life insurance. Term life insurance provides coverage for a specified period, usually 10, 20, or 30 years, and it pays out a death benefit to your beneficiaries if you pass away during the term. Term life insurance is often less expensive than whole life insurance, with premiums that can be 50-70% lower depending on the insurance company and the term length. This makes term life insurance a more affordable option for many people, especially those who are on a budget or who have limited financial resources. Another advantage of term life insurance is that it's simpler to understand and manage than whole life insurance. Term life insurance policies typically don't have a cash value component, which means you don't have to worry about managing investments or dealing with complex policy provisions. This simplicity can make term life insurance a more attractive option for those who want a straightforward and easy to understand life insurance product. Additionally, term life insurance can be used to cover specific financial obligations such as a mortgage or car loan, which can provide peace of mind and financial security for your loved ones. For example, if you have a 30-year mortgage, you can purchase a 30-year term life insurance policy to ensure that your mortgage is paid off if you pass away during the term. This can be a more cost effective and efficient way to manage your debt and provide financial protection for your family. Now, let's take a closer look at how term life insurance works and how it can be used to achieve your financial goals. Another alternative to whole life insurance is index funds. Index funds are a type of investment vehicle that tracks a specific stock market index such as the S&P 500 or the Dow Jones Industrial Average. Index funds provide broad diversification and can be a low-cost way to invest in the stock market. One of the main advantages of index funds is that they offer a consistent and reliable way to grow your wealth over the long term. Historically, index funds have provided higher returns than whole life insurance with lower fees and less complexity. Additionally, index funds are often less expensive than whole life insurance with management fees that can be very low per annum. This means that you can keep more of your money and achieve your financial goals faster. Index funds also offer flexibility and liquidity, which can be beneficial if you need to access your money quickly. You can typically withdraw your money from an index fund at any time without penalty or surrender charges. This can provide peace of mind and financial security, knowing that you have access to your money when you need it. Now let's explore the different types of index funds and examine the pros and cons of each. So why do all life insurance policies often fail to deliver on their promises? One of the main reasons is that they are complex and difficult to understand, even for financial professionals. This complexity can lead to misunderstandings and mismanagement of the policy, which can have severe consequences for the policyholder. For example, if you're not aware of the fees and charges associated with your whole life insurance policy, you may end up paying more than you expected, which can reduce the cash value of your policy and the death benefit paid to your beneficiaries. Additionally, whole life insurance policies often come with surrender charges, which can be hefty if you decide to cancel the policy. These charges can range from a few $1,000s to tens of thousands of dollars, depending on the policy and the insurance company. This means that if you need to access your money quickly, you may be penalized for surrendering your policy, which can be a significant financial burden. Another reason why whole life insurance policies often fail to deliver is that they are often sold with unrealistic expectations and promises. Insurance agents and brokers may promise high returns on the cash value component, but these returns are not guaranteed and can fluctuate over time. This means that if you're not careful, you may end up with a policy that doesn't meet your needs or expectations, which can be a significant disappointment. Now, let's discuss some strategies for avoiding the pitfalls of whole life insurance and making informed decisions about your financial situation. So, what's the best way to protect your loved ones and grow your wealth? The answer depends on your individual financial situation, goals, and needs. However, for most people, A combination of term life insurance and index funds can provide a more straightforward and cost-effective way to achieve their financial objectives. Term life insurance can provide a death benefit to your beneficiaries if you pass away, while index funds can help you grow your wealth over the long term. By combining these two products, you can create a comprehensive financial plan that provides peace of mind and financial security for your loved ones. Here's an example of how you can use term life insurance and index funds to achieve your financial goals. Let's say you are 30 years old, married, and have two children. You want to ensure that your family is financially protected in the event of your passing, and you also want to grow your wealth over the long term. You can purchase a 20-year term life insurance policy to cover your mortgage and other financial obligations and invest in a total stock market index fund to grow your wealth over the long term. By doing so, you can create a comprehensive financial plan that provides peace of mind and financial security for your loved ones while also growing your wealth over the long term. Now, let's discuss some additional strategies for achieving your financial goals, including budgeting, saving, and investing. As we discussed earlier, whole life insurance can be a complex and expensive product that may not be the best fit for most people. However, there are some scenarios where whole life insurance might be a suitable option. For example, if you have a large estate or a complex financial situation, whole life insurance might be used to cover estate taxes or provide liquidity for your beneficiaries. Additionally, if you have a permanent insurance need, such as insuring a business partner or providing for a special needs child, whole life insurance might be a suitable option. However, for most people, term life insurance and index funds can provide a more straightforward and cost effective way to achieve their financial objectives. It's essential to carefully consider your financial situation, goals, and needs before making a decision about whole life insurance. You should also seek professional advice from a qualified financial advisor to ensure that you're making an informed decision. Now, let's discuss some of the risks and warnings associated with whole life insurance. In conclusion, whole life insurance is a complex and often expensive product that may not be the best fit for most people. While it can provide a death benefit and a cash value component, the fees and charges associated with whole life insurance policies can be substantial, and the returns on investment may be lower than expected. For most people, a combination of term life insurance and index funds can provide a more straightforward and cost effective way to achieve their financial objectives. By understanding the details of whole life insurance and exploring alternative options, you can make informed decisions and achieve your financial goals. Remember to always read the fine print, understand the fees and charges, and seek professional advice from a qualified financial advisor before making a decision about whole life insurance. By doing so, you can create a comprehensive financial plan that provides peace of mind and financial security for your loved ones while also growing your wealth over the long term. Thank you for watching, and we'll see you in the next video.